Hey everyone, you're listening to the recap by Drawing Capital, the best place to dissect the week's key events and investing in technology in 15 minutes or less. The information provided is for informational purposes only and does not constitute an offer, solicitation, or recommendation regarding any investment product or service. Any reference is not an endorsement by Drawing Capital, nor a recommendation by Drawing Capital to buy, sell, or hold. Listeners should determine for themselves whether a particular service or product is suited to their needs or should seek professional advice for their particular situation.
Welcome back, everyone. We are officially in the month of April for 2021. Markets were closed this Friday due to the holiday, as many of you may know, but let's kick it off with our usual routine and recap of the markets here. So, year-to-date performance since last week, the Dow Jones was up 8.03% for the year last week, now increased slightly to 8.32%. The S&P 500 was at 5.8% return last week and now just a hair over 7%. The NASDAQ turned positive for the year last week, sitting at 0.65% and is now gaining back some ground and sits at a 3.42% return for the year. ARKK, our innovation benchmark, was down 8.5% last week and is now regaining some footing, down only 2.92% for the year. Lastly, our best friend, the 10-year U.S. Treasury, which was at 1.657% yield last week and now at 1.679, and is having a field day with discounted cash flow models everywhere. So we're covering some exciting stuff for the week, including a major hedge fund meltdown and COVID's effect on the real estate market. To jump right into it here, Sagar, some people may have heard of the Archegos Capital, which is the Greek term for margin call. Can you give us an overview of what happened and the implication of this epic meltdown for the rest of the markets?
Sure, it's a great question there, Sean, and thanks for organizing this as always. Archegos Capital really serves as an important repetitive lesson to investors, which is that leverage does not imply genius. Nonetheless, we should respect the privacy of the family office, yet at the same time, we can learn three important lessons from this event from an individual investor perspective. First, leverage both magnifies gains and magnifies losses. In positive trending markets, leverage works wonders, but then being levered long on the downside can be particularly painful. Whenever borrowed money is used to finance the acquisition of investments, or when complex non-retail oriented investment products are used, there's additional risk and hurdle rates in the investment decision-making process. Second, significant selling can impact stock prices, as seen by the recent stock price movements of Viacom, CBS, Discovery, a few Chinese stocks, and other securities. Third, buying from diseconomic and distressed sellers can present actually a very significant investing opportunity for patient investors. So all in all, a number of lessons that we can learn. And nonetheless, as we've seen both in January and February with the GameStop situation, as we see here in late March and early April, of course, the causality of those two situations are different, but nonetheless, whenever there is leverage or borrowed money being used, there is an amplification of both gains and losses there.
Yeah. Thank you for your feedback, Sagar. Jugal, anything to add to Sagar's statements there?
Yeah, I was just thinking about it as well. And one thing that sticks out to me just reading, at least from the news articles online, was that I think Bill Huang was getting around $85 of buying power for every $15 that he put up. And for me, as someone who might trade in a retail account or something, why is it that I can't get access to margin rates or to buying power of that sort of magnitude where I can get like almost 5 to 6x? I'm like trading on Robinhood or something. I'm tied down to maybe 2x of what I actually put in. And then the second thing is, I think I was reading that Bill Huang was almost owning about 25% of some of the companies that he was investing in, which is crazy because while these companies do have liquidity for the average investor, when you have 25% ownership of a company, the liquidity is almost kind of gone because you're basically trading with yourself at that point. So if anything causes you to get margin called, you're your worst enemy. Sagar, do you have any thoughts about that?
Yeah, I think it's a great question. I think first there is the use of different types of products. So in this particular case, there was the use of equity swaps, as seen by the online articles and other journalism that was written about this. And so equity swaps are very common, I guess, in the institutional world, particularly for actually just in the general swap market, interest rate swaps and future swaps and the like. Those are very common by institutional investors. I guess for the individual retail investor, though, it is certainly not a common product. Most of the time, I would say many individual investors either look at individual stocks, ETFs, index funds, mutual funds, maybe some options. Of course, there are risk associated with all of these as well. So I think there is an increasing of the aperture when it comes to the size and scale of some of these investments. I think you're correct there in that both one, it's the leverage requirements are different. Number one, number two, what is the borrowing rate? And whenever borrowing interest rates are closer to 1 or 2%, it just increases the propensity or the tantalizing nature of using leverage in order to magnify positive returns. So I think there are a couple of components there. Of course, we don't necessarily know the entire story until this saga fully really concludes. But nonetheless, I think there's important lessons for both institutional investors as well as retail investors that we can have and really have a number of key takeaways for.
Sagar, for the people listening that don't understand what a swap is, can you just go back and explain that for them quickly?
Yeah, of course. So it's a great question. So an equity swap is really an exchange of future cash flows between multiple parties, and they're really used to diversify either an income set or gain exposure into a specific investment. So, for example, we'll use it outside of the equity swap realm, but let's say for the individual investor that's let's say looking to buy a call option. When you buy a call option, you are buying the right but not the obligation to actually buy that stock. But nonetheless, you are essentially rooting for that stock, or you're cheering for that stock to go up if you have bought a call option on that stock. So an equity swap is a synthetic way of gaining exposure to either a basket of securities, such as an index, or an individual stock or sector in question there.
Yeah, and I think also just in terms of borrowing, and we look at brokerages and banks, and I think the number one thing that contributes to that, just going back to what Jugal was saying, and retail investors versus institutional investors, is things like buying power. If you and I, a normal retail investor, go to any broker dealer and we want to negotiate some sort of better lending rate, they're going to look at the amount that we're looking to borrow, any other future lines of business, and being, a multi-billion-dollar institution and something like Bill Huang was running, obviously they have better negotiating terms and kind of, pin different providers against each other in order to gain some preferential rates or, in some cases, lending power, what you can borrow against and how much you can leverage against those assets. And something that, used to occur all of the time, and I think it's gotten a little bit better since 2008 and the Dodd-Frank Act and things like that. But before the great financial crisis, for a lot of people, that you could leverage treasuries 10-1. So if you had a portfolio full of U.S. treasuries, you could borrow essentially 10x that value and use all that additional lending and borrowing power to go out and buy stocks, speculative in nature if you so choose. But to shift gears here to a different topic, and I know we've chatted about this recently, all of personal interest to us, but COVID and the changing environment for work from home, consumer buying habits, whatever it may be, has dramatically changed the way that we do business, and for things like the real estate market specifically. Jugal, let me toss it over to you. I know you had some thoughts around that. Can you give us an overview and what you're thinking as far as COVID and the real estate market and their relationship to one another?
Yeah, definitely. This has sort of been on my mind for a long time, and I think COVID has been obviously the catalyst for many things, but this one is in particular very interesting because I don't think enough people talk about it. But so basically, there's been these three sorts of trends that we've noticed, and one of them is VR and AR, which started a couple of years ago, and then there was the work from home trend, and then lastly there was the mental health trend. And so all of these were kind of going on, but I don't know if a lot of things were actually being done to help these causes, or to relieve these causes for as far as mental health goes. But then COVID comes along, and then all this stuff starts blowing up. And basically, we're now living in this sort of like digital world where VR is really taking over. I think Facebook's pushing Oculus a lot. There's things like Roblox, and the whole idea of a meta universe where everyone's just talking and socializing in this digital world. And then there's the mental health aspect where obviously everyone's sort of quarantined. People feel alone, and they want people to be with. They want community. They miss the social aspect of being in the office. So then it becomes more important to have co-working spaces, that offices that you used to get in an office that you can't have anymore. So I start seeing these things like apartment complexes coming up where they actually do have co-working spaces where people can come from their room, come down, sit on the couch, and work in a room with three other people that are also doing some sort of remote work. And then some of these apartment complexes are actually building private offices that you can reserve within the complex because work from home is becoming so popular. And I think people are going to start looking for something like that as they move away from their hometown and start working remotely from places like Texas or Florida, etc. And the last thing, actually, I wanted to pass it over back to Sagar, because Sagar, you mentioned you've seen this trend where there's been an increase in sort of sunlight and nature when building houses. There's more windows, there's more scenery, rather than like a prison-like wall where people just feel like they're always in the dark and alone. What have you seen there?
Yeah, that's a great question. I think at the individual level, what we're seeing is, especially in these suburban communities, we're seeing expansion in more and more building. And I think it always goes in cycles, but nonetheless, for those that have discretionary savings, we're certainly seeing in some parts of the Bay Area and Silicon Valley, there's several people that are both building brand new properties, but also at the same time expanding their existing properties to include, let's say, a sunroom or another office. So I think the key takeaway, I know this is just one a very, very niche example, but still very relevant, is that despite this being just one example, I think the key takeaway here is that digital experiences are now impacting and influencing physical relationships and physical ways of both living, commuting, et cetera there. And so, and previously it used to be that physicality impacted digital relationships, but now that situation is flipped. I know Jugal already mentioned that several new condos and apartment complexes are building more development of, let's say, soundproof rooms and co-working spaces and the like. And I think that's all really great, and it creates that more group-like approach there. But I know Jugal had several thoughts on this, and he's had a lot of exceptional insights, and I'll pass it back over to him as well.
Yeah. So the one more thing I also just thought of is, people that were working in the Bay Area specifically, they thought, I could go to work for about 10 hours a day, and I don't really need a house to come back to that I like care about. I just need a bed and basically like live in a closet. But now with work from home, that's changing. People really want space and they want freedom. They want a place that they're going to be happy living in rather than just a place that they'll be in, for 8 hours a night sleeping. So rather than paying $900 a month for a closet, people are now going to put a higher price on getting a place that they can live happily in. And then on top of that, with the shift to VR, there's also going to be a need for large open spaces in houses, because obviously you can't really do VR type of stuff when there's furniture all over the place because you're going to hurt yourself. So I just see there's just going to be a larger premium on real estate in general because of all these trends sort of combining. And yeah, those are my thoughts. Essentially, I think the prices of real estate is going to continue to go up, but obviously, as people shift away from cities and crowded areas, there's going to be much more of a I guess there's less inequality in terms of prices across the entire country. Like, the prices of New York will come down, the prices of San Francisco will come down, but the prices in Texas, like Austin, Texas, I've been looking at the Airbnbs there. The prices have been going up dramatically. But yeah, I think the prices will converge across the country because of work from home.
Great. Well, thank you again, everyone, for joining us this week. We hope you found it insightful. We talked a little bit about the Archegos Capital debacle and touched on real estate trends given COVID going forward. And we hope to see you all here again next week.